So the big news this week is Tanner Construction established a VC arm. So Tanner, obviously one of the largest construction firms, has now created Tanner Ventures, which is going to invest in solutions for AEC. And they said that they'll focus on AI, digitalization, and decarbonization, and specifically provide value in terms of mentorship, being able to collaborate directly to pilot, test, and validate innovations from startups, and then also making these strategic capital investments. And they kind of join other firms such as Suffolk Tech or W&D Ventures out of DPR. And the question that I wanted to bring to both of you in this group here is, should construction companies operate as CVCs? Should they be investing in startups? Is there value in that? Like one side from an investor and then the other side from you as the startup founder. Do you really think that that provides value? And then also there's the other side of, does the construction company also get value, or could they be allocating that capital in different ways?
A great first question to kick it off. All right. Well, it's a lot there. So I can really speak to our experience and maybe some observations. Building a business is very complex. This is not a simple thing. It's a continuous effort. Like it's got to keep it moving and in flight. So venture capital, like the institutional venture capitalists are here to place bets on founders. I will say founder first, then is their idea worth investing in? Okay, so both those things are, in alignment, then it's really about capital allocation, and it's not about tripping up your roadmap, or going on any kinds of detours in your roadmap for a specific pot of gold that you're trying to go get. So without corporate VCs, you can thrive and go get product market fit in a way that you can't when they're demanding, all of your attention, right? Okay. So why would TestFit take on a corporate investor? Blew through $1 million ARR with just a $2 million investment, with one VC. And we did it in one market. Like we were stuck in housing, doing high density multi. And I started to fear for us being a one trick kind of pony, like stuck in one niche, not ever able to get out of it. So I started looking around for who was big, in real estate, because I felt like we needed a real estate investor. So, right, you're a startup founder, you're kind of reading the road and you get new information, and okay, real estate's really important. Real estate investors really important. Okay, here's the list of 15 REITs that do some kind of investment. All right, well, which ones are taking the riskiest possible investments? I'm not here to go get someone a 20% return. I'm here to go get someone like a 200% return, like a lot, right? And so they need to be willing to take a lot of risks. For us, that was like Prologis Ventures was at like the top of the list because they're attached to, the largest real estate investment trust on the planet. They were in a market that was growing rapidly at the time, which was light industrial warehouse. Like the logistics revolution was upon us because of COVID. And we needed someone that could shine light in a very dark part of the market we didn't understand. Yeah, we did a really great deal with Prologis, and they totally changed our roadmap for the better in a lot of ways. And because of their size, they forced us to grow really quickly into what I would say is like what a corporate investment wants you to look like. So like you need the ability to serve all of their company and to do it across borders and to have data security and data privacy. And so your compliance and stuff that is completely not related to innovation starts to become really important. So you have to weigh, do you have product market fit in the current niche that you're in? Because if you don't, it was not a good idea to ever go after corporate VC, because it is a challenge to get their tranches through the door, and then it is a challenge to earn their business, and it is a challenge to keep them, at renewal. Like they helped us. I think we might be on like the 20 to 8, maybe it's an 80-20. I think we're on the 20 side where like it really did help TestFit mature and grow into a much better business working with Prologis. But Ryan and I were in our 20s when we founded TestFit. We're feral in a lot of ways, getting to product market fit. And like we needed a corporate partner like them to frankly to like sharpen me enough to be able to like, okay, here's what your $1 billion, like if I'm going to be the architect for your $1 billion corporation, here's how I would try to think about designing buildings, right? And I didn't know that I had to go earn the right to have that conversation. So it's very humbling. All right, so let's talk about Turner. Yeah, so your corporate VC partners, they're going to be filled with a lot of ideas about what you should do, right? And you're not a startup founder because you really enjoyed hearing all of the ideas of what you should go build, right? You wanted to solve the problem for people. And so there's a cultural issue. I think that like you need to have this humility when you're stepping into a room with, 30 years of experience to your 30 minutes. And so you have to understand like even the language that they're trying to speak to you through, which is like RFPs, RFQs, stuff that corporates know. Thankfully, like I had done a little bit of that work in the architecture world to kind of slow down and be like, okay, we need to have like a pitch deck here. Because up until we got into some of these enterprise deals, like I'd pitch to some firm, and within 10 minutes, if it sounded like they'd be a SQL, they're my best friend. If it sounded like they're an MQL, like okay, just follow us on Twitter. I'll talk to you later. Here you have to stop, spend a significant amount of energy to go respect the people that think that they know the problem. And they might very well know the problem, but you're the founder that's got to go execute on a vision that you have for a problem that's 80% of that guy's problem. So you got to figure out how to bring him under, into your tent. And like, this is a soft skills thing. This is a charming thing. This is like not what you're used to because you've been, lighting the world on fire with your product. And yeah. So I would say like for Turner to say that they're going to go do these investments, hell yeah. Like we need more GCs willing to take a 10x risk, right? Like I'm never going to say no, don't go blow as much money on the future as possible because they should be. But at the same time, like know that you are not the visionary. You are not the general partner that has to go execute on this vision. And your intellectual property is actually getting in the way of us being successful. So like you have to have some humility on the corporate venture side as well. Um,
Is there a bit of stage fit then of at a pre-seed to a seed, you don't want a corporate person coming in and trying to push their vision on, but maybe at a series A or a little bit later when you have the product market fit, they're a really good partner.
So I failed to sell TestFit personally over 3,000 times. And you get those failure reps not in, your best friends are in the long tail. They're not the big whales that are going to teach you how to get the intellectual muscle to then go take on a big whale. And so it's TestFit's a very different journey. Like we didn't come in with I don't know, like a white paper or a doctorate of whatever. Like we're like two entrepreneurs. So like we just read the road. And early on, like I'm burning a lot of energy with large companies. And that's like you cannot be successful burning a lot of energy. You have to go find sales. Now there's other approaches that maybe I should have taken, which was, maybe you go do raise $50 million and you go talk to all the big architecture firms and you get a list of features that they want, and then you go hide in a box for 2 years and you crank through like what you think the thing that they want actually might be. Seems really inefficient to me. Seems like you're leaving the possibility of building allies in the long tail, the guys that are your word of mouth guys. Like you're not really investing, in these little relationships. And the little relationships are the ones that build your culture, they build everything. So like I love Prologis. They're the reason why we are likely going to continue to be massively successful in a lot of ways. But it was a big distraction for many years, like for 2 years to go get, to go push the corporation in a way that it needed to go be pushed. Yes, we weren't ready. Like maybe after Series A would have been the right time, but you've got to start ramping. You always are ramping for what your next scale looks like. And the best advice I can give is like, you as the founder know your company. Like, it needs to be on your limbic system. You need to fear the same way that you fear for your life, for your company. And if you think that just one major win from one customer is the thing that will get you across the line, I don't know. Like, that's what corporate venture kind of is. Like, they're like, well, we will teach you everything you need to know to be, successful. And like, it's maybe true, but corporates, remember, you have a lot to learn from the startup founder because they're the ones that are sharpening the problem in a way that it turns it into like a solution for that problem. And the problem has to be big enough.
What's your opinion then, Alice, on seeing more of these CVCs, especially as construction companies coming up and investing in startups? It is not natural to them, obviously, on one side, and they have thin margins. So it is sometimes surprising to see that and try to understand, hey, what is the strategic reason of them doing so?
Yeah, I think there's a lot of different reasons as to why a CVC ends up getting set up, right? CVC is corporate venture capital, in case we didn't explain that. But yeah, I would say like in the last 5 to 10 years, we have seen a good number of CVCs pop up, and it's across the entire supply chain. So like Turner is for GC, and you named a few. We've also seen a lot of CVCs come from the material supplier side. Now trade contractors are launching, even if it's not officially a CVC, but some type of investment vehicle to get involved with the space. A lot of the times, like I don't know exactly what the reason why companies are setting this up. I think sometimes it's part of a corporate innovation program, right? It's like, oh, we're seeing all these startups, like let's formalize a way for which our innovation team and our business units and project teams interact with startups with an opportunity to invest. And frankly, on the kind of like on the institutional VC side, right, there's a lot of signaling that happens when a corporate or a strategic investor gets involved on the cap table. And that's like, a lot more to unpack there. But in terms of reasons, right, CVCs, a lot of it is very strategic. And that's why, as both a founder and an investor, you kind of have to understand what they're going after, right? Because if it's a pure strategic CVC that doesn't care about financial returns and only cares about investing in companies that they may want to acquire, like that is a huge red flag for institutional VC because
It's just like a dual agency problem all over. Like, in real estate, you can't have the same broker represent you on the buy side and the sell side. Like,
exactly,
it
exactly. Yeah. Yeah.
so it's just like it. Okay, I see what you're trying to do, and nobody's gonna get mad at you for trying to innovate. However, we set up the United States to be a very capitalistic approach, and like that's how we assume people are gonna want to make money is this way. So then you'll confuse the founders, you'll confuse other investors about what you're trying to do with stock or with. So if the deal doesn't make financial sense, you just don't do it. Oh, we're doing it because we want to lose a bunch of money. Like, no, don't do that. Well, maybe, hey, we had a bunch of profit and we need some losses to offset, our taxes or something. Like, there's some really stupid decisions people can make in the name of like tax reduction. Remember, if you're going to go place a bet on something that doesn't have any real financial return associated with it, you're going to create a fake market that doesn't exist. Like what the real problems really are.
But that's where I kind of disagree with you, where there are some corporates out there that are investing for the future, right? And like one great example is Obayashi. They're one of our LPs in our fund. In Japan, they have 50-year plans, and they're thinking about the world and construction in such a long-term kind of vision that like they're thinking like, oh, if we want to be here in 20 years, what do we need to do to get there? And they are strategically and actively investing in things. And this is not just in startups, but this is across, like buying companies and all that. But, the way that they think about it is like, okay, we actually don't mind being the bleeding edge, right? Like we want the industry to go in this direction, and we are willing to bet on things that will get us there, even if financially it may not pan out, right? And it's not that they're not.
So more what I'm seeing, an artificial market is like there's a massive market for VR and AEC. But people are like they just pump money into it, and so it creates this artificial demand that maybe was never there. That's what I'm saying. Like that distracts from the core problems. I'll talk about Prologis again. They build warehouses to last more than 50 years. Okay, how many people are doing that? Actually, not that many. and then they'd be like, well, can we make them last even longer, right? So like the guys like Obayashi, like they're starting to get the point of having a long-term vision about how to improve the world.
Yeah, but this is not like strategic versus institutional VC. I think this is now like generalist VC versus sector specific or like people who know construction, right? Because we know for a fact the whole VR thing, right? We're still getting pitches on VR for construction, right? It's like no one on a construction site, due to safety, is going to put on a VR headset while things are moving around, right? Like it just makes no sense, right? Yet a lot of those companies got funded, and they're funded based on tech hype by generalist investors who don't understand construction. So I feel
Yep.
like, yeah, like, and when we talk to founders, it's like there's more or less three categories, right? Generalist VCs who don't understand construction. Actually, no. Those VCs, some understand construction, some don't understand construction. And we love the ones that have put in the time and effort to learn our industry. And then we have like built world focused ones, and then you have corporate venture. And when it comes to fundraising and figuring out who's on your cap table, it is very much a like strategic game that you have to play with like, all right, how do you get the most value out of all of your investors? But also when you're thinking about the next round, how do you build your cap table so it doesn't spook potential future investors, right? And when you're thinking about it from like founding up to Series B and beyond, like that in itself is almost like a strategy if you're able to get a lot of interest. And then sometimes you're stuck with, well, only so and so is going to write me a term sheet. So I'm kind of just stuck with those terms and I'm stuck with these investors.
And just don't do it. Just don't do it. Hey, if it's a bad deal, don't like slavery. Don't do it. You don't have to. Like failure is always an option. And then write about how you failed, and then everybody else will actually trust you more than if you did a deal you didn't believe in and carried a bunch of people, along the way. Something might not have been that great, right? I like generalist VCs. I think they get really they're the ones that create all the hype and stuff, and there's like a very big value to that. I think it was like, whenever I go to a series B or C or D or whatever, like we got to go find more millions than what, the specialist VCs are going to go have in AUC, right? So you got to go find people that are marketers and salesmen at the next scale. And it is a completely different ballgame too. Like your business needs to start to look like like your paper has actual value to it, right? And that's a different challenge in of itself. And you don't want like a strategic to start dictating where that path is going to go. Because their vision for you might have been to solve this one specific problem that they needed solved at at your Series A. You might blow right past, what that vision for you was. And, so they might not also feel like they got, most out of the most out of the relationship while they had it either. Right. And then in the boardroom, like, and in your cap table, I would say if you're 100% generalist VC, it's a bad thing. If you don't even entertain having a corporate in your boardroom, it's probably a bad thing. They all are positives and negatives on the cap table in a very balanced way. And this is what you want to build in your corporation is checks and balances internally on bad ideas as a founder, because you do have bad ideas. You don't have operational experience like at all, really. They've got to help generalists. I'd say the ones that are used to building big corporations, they're really helpful at that kind of thing. Specialists, you're trying to go meet like, DPR. So I think the first time I ever met DPR was through like Curtis, brick and mortar. So like they're going to have the kind of relationships to the corporates. Yeah, they'll introduce you to, well, or maybe not. I don't know. They'll introduce you to the corporates, but the corporates are like the ones that you want to be really, really careful about, because that one more than any of them is a marriage.
Yeah.
And you don't want it to end up in divorce before you even sign the papers. Dead on arrival, maybe. And dead on arrival happens when you've said that you're something that you're not, and they've said internally to others that you're something that you're not. And it's all about really the clarity of the vision that you're going to pursue together. That's probably the same advice I'd give to people that want to get married too. I'd say the same thing.
It is.
Yeah.
what is it? They always say this stat, like the average marriage is 7 years in the
Yeah.
U, and the like investor founder relationship oftentimes lasts a lot longer than that, especially if you're early stage.
Yeah. So funds last about 7 years, but if you can keep going with your initial investors, they'll re-roll and keep going with you, right? So that's a good sign if they want to keep, non-dilutive investment.